Thank you all for joining us today. My name is Jessica Wynn. I'm the Vice President of Meetings and Professional Development here at CQ. Before we get started today, I want to provide a quick reminder about the content shared today. The purpose of today's webinar is for informational purposes only and should not be considered legal advice. If you are in need of legal advice, we recommend consulting an attorney directly. For our CQ member attendees, today's webinar will be recorded and available on the CQ website within the next day or two. If you need help finding that or logging in, please let me know. Today's webinar is titled, How Many of the New Financial Triggers Can You Name? The webinar will be presented by Mike Wary and Tom Wilson with McClintock and Associates. Throughout the presentation, please submit your questions in the chat. And with that being said, I'll go ahead and turn it over to Mike.
Thanks, Jessica. Appreciate CQ having us today. Introducing, for those who don't know Tom Wilson, he's been a senior manager with McClintock now for, I don't know, it's somewhere between 10 and 15 years, Tom. So he's been in the sector with us a long time, specializes in financial statement audits, and I'd say is probably our technical leader in that area at the firm. So having him involved today on some of these financial triggers and our composite score is really good. So it's great to have him here today. As Jessica said, this is a webinar, so it's not official advice. We're certainly not attorneys at CPA, so certainly everyone's situation, everyone's circumstances can be unique. So the idea is to provide high-level guidance for you, put the topics on hand for you to think about, and then follow up with your professional advisors, whether it be us or others, with really specific questions. Excuse me, just a couple reminders on the McClintock website for you. We've got issues out there talking about the article. We have articles out there talking about the issues and other information going on in the sector. We find it's prudent to get information from multiple sources. We have a saying here that you got to hear something 7 times before people really understand it. And I even found myself reading information of what's going on in the sector from different organizations has value, because people highlight different things, and just reading it multiple times allows it to stick. And so please feel free to use our website for articles that are out there. And also for resources, we've put some resources out recently. We've got some 90-10 tools to help people with all the new changes that are going on this year. We have a Pell calculator we put out that schools can use to help estimate and compute the 24-25 Pell amounts. That our financial aid team did a webinar internally, and that's going to be available out on our resource page as well. So there's just a lot going on in the sector for today. So please use these tools to help you stay on top of everything. That's kind of the segue for today's topic, talking about some of the financial triggers that are changing. Just preparing for this webinar, it's just amazing to me how much ED is trying to get done from a regulatory standpoint, and the amount of changes they're throwing institutions is just overwhelming to stay on top of. Obviously, it's ironic that they can all of a sudden get new rules issued for student loan forgiveness, but yet are struggling to get the FAFSA correct. And as I'm having a senior in high school, for once, I'm really personally invested in getting the FAFSA and getting it done right. So my son's college application can go through. But just thinking about all the data they're putting out, it's just more information, right? So we've got brand new financial triggers that are taking effect July 1st, 2024, that we want to talk about, along with some impact to consider of what that's going to be for your institution. And then along with the triggers, the department made a few changes to the general standards to financial responsibility as well. These changes are also effective July 1st, 2024. And then we're going to talk about just a few composite score reminders. Since this composite score is part of the financial responsibility, we're going to give some insight on changes that have happened in the last few years and some updates and reminders and things we've seen in audits that we thought would be prudent to put on everyone's radar. As we've gone through audits, one of the things that we've seen, at least what we've interpreted, is that the financial triggers aren't necessarily top of mind for every school. Especially if you're not failing any, it's not things that schools think about a lot. We're not saying this to be critical. I think it's just one of those things. There's so much going on between BDTR that you're getting notices on. Gainful, you have to do reporting on. There's FAFSA delays. You're trying to figure out how to package aid for the upcoming year. That the financial triggers just aren't necessarily on a school's radar of understanding what they are. Have I tripped any of them? And what's my processes to really monitor those, evaluate them, and then make a decision of whether they need to be reported. And in some ways, maybe we've been a little remiss of keeping them front of mind for clients and helping clients work through the sub tools and processes so they are front of mind and they don't get overlooked with everything else that's going on in the sector. So that's we think it was kind of a good time for this webinar. So I'm going to cover the triggers, and then Tom's going to cover some of the impacts and the general standard changes and reminders. And just as a kind of a history lesson for everyone, these rules got published October, I think it was 30th, 2023. I can't remember if it was the 30th or the 29th. They were covered with financial responsibility, administrative capability, ATB, that whole set of packages, that rules that went into effect that got passed before November 1st and then go into effect July 1st, 2024. All right, so triggers. We're going to go through all the triggers and talk about what has changed July 1, 2024. So the purpose is to give ED insight between audit submissions, because most schools, as a private company, they're only getting information on your financials once a year. Even for public institutions, they've only got to submit, publicly traded institutions only have to submit audits once a year. Now, the department can certainly glean information from 10K filings and other releases, but for private institutions, all they know is when they go through those audit reports. And so the concept of them getting information that could be troubling or, that would imply there's financial problems going on, to me as a regulator, is not totally unwarranted for the department to be able to have some insight if there's things they need to react to. The concern in some of these triggers is the thresholds they sent and or the discretion they have and how they apply that discretion. As always, the devil is in the details, and one administration can certainly look at things different than another. I did see an article the other day that said, I forget how many schools it was, but since 2016, it listed all of the schools that have closed, and that was just traditional schools. And so, departments are aware of this. Continuing articles come out about schools in trouble. So the department wants to be certain from a protection of the taxpayer that they are, they're doing their due diligence. So when they get called up to the hill in front of Congress, that they can justify their actions. Again, it's how some of this will be enforced and the discretion they have, which will give us some pause. So the department has put in a couple triggers. There's mandatory triggers, and I've listed the regulatory site, and discretionary triggers, which are currently in. They've just expanded these triggers. Mandatory triggers is that if you trip that trigger, it's automatic failure, and you post financial protection, a letter of credit. Except in a couple of cases, a couple of them you actually recompute the composite score that we're going to go through. So you can have a trigger, you can recompute the composite score, and you still may be fine if you're above a 1. In that case, you don't have any financial protection required. Discretionary triggers are kind of what they say. They are at ED's discretion. In some ways, those are the ones that give me greater pause as to how they'll be interpreted. These are for all institutions. Except for the triggers related to the equity items, those things aren't going to be as applicable to nonprofit entities. But otherwise, all their reporting is pretty much going to be the same. And so they're going to be getting an overwhelming amount of information potentially from the entire sector of higher ed. They did change the timing from 10 days to 21 days, which I think was good. 10 days is fast to figure out, did you trip it up, to evaluate it? What if someone's on vacation even? It just doesn't get identified immediately. So it's 21 days to report, except for 90/10, which is still 45 days from the end of the fiscal year. I think one thing that we would say is for schools have failed 90/10. Historically, we've not seen many of them report it within 45 days. Sometimes there are schools that aren't quite in tune with what's going on in the sector. They're not members of CQ. They may not be using a CPA firm that's in the industry, and they're just not aware of that, which is an issue. Not reporting a trigger is an issue as well. So it's causing almost a double whammy for those schools. The reporting website is here. And as I mentioned, failure to report is an issue as well. ED says that they'll require separate financial protection if you have separate financial triggers. So if they're two unrelated items, you could have to post multiple letter of credit. The regs do say, or in the preambles, that department won't hit a school for multiple letters of credit for the same issue. If one issue causes multiple triggers, in that case, it only hits you once. I am a little concerned on stuff that maybe you fail the 910 and then you don't report it on time. That discretion, is that one letter of credit, or could that possibly cause two? So those are just for ED as discretion. That gives us concern as to we start seeing how they're going to interpret it. They did provide more clarity in my mind that financial protection must be held for 2 full fiscal years for automatic or discretionary triggers, and 1 year if the trigger is due to a composite score recalculation, and then possibly you could come off it if your CSR passes the next year. ED has said they have discretion to release the letter of credit based upon the triggering event or the review of subsequent annual financial statements. So while they have timeframes in there, they always have the discretion to make other decisions. And of course, I think many schools have seen that, not just in financial triggers and financial protection, but just the discretion ED has. And how it works, and Tom will talk about it, for some of the triggers that require a composite score change, they're going to take your last submitted composite score. They're going to take the triggering event, and there's a very specific way they're going to recalculate the composite score. And basically say, okay, if this event happened in these last audit we have, what is going to be the impact? They are not going to use any other current year data in doing that recalculation. And as Tom will show, the ones that do get recalced, how that change flows through the composite score. All right, so let's talk about what the triggers are. And I have bucketed these into different brackets. So as you see in here, I've listed them kind of the Roman numeral of where they fall in the regs, whether it's little I, little I2, but I've not listed my presentation in that order. I've put them together in a bucket and grouped them. For me, it's easier to understand that way. And as you think about an organization, it may make more sense to do it, to bucket it, like who's responsible for this bucket and who's responsible for that bucket, and things we'll talk about. So this first bucket is legal and administration. And I'd say anything that happens here, to me, is like one of the billboards for a defense attorney. Like if Tom is your attorney and you have something that falls here, you know, my answer is that it's 1-800 call Tom, right? You want to get your regulatory counsel involved as soon as possible at any of the things that fall onto this page. The first one is financial monetary judgment, award, settlement from a legal proceeding. This is one, if you're below a 1.5 and you have any of these, department wants to know, and they're going to recompute your composite score to see if it pushes you below a 1.0. There is no materiality for this item. This is one of the ones, you know, going back to when these triggers came out in 16, you know, of reporting any type of financial monetary judgment or award, slip and fall, I mean, any type of, you know, employee EEOC claim, you know, employee claim, it could be small dollars, but you got to report it. And this is where I just see department getting overwhelmed with information from schools, but that's what the standard says. So just, you know, keep that out there as for any type of legal items. The second one is institution is sued by a federal or state authority. Again, and they've defined penalties, fine, financial relief, key TAM, and the action is pending greater than 120 days. There's been no motion to dismiss or the motion's been denied. So obviously this is, you know, a state attorney general action, some other agency coming after you. And if it's, you know, obviously if it goes away or the motions to dismiss, then okay, there wasn't much claim there. If it's outstanding more than 120 days, you got to report it. I don't know as an attorney of these, when these things come up, how many of them get dismissed and how many really go on and maybe they don't end up in anything, but they still go past the 120-day point. That's something your regulatory counsel can give you insight in. I think a larger school chain, multiple states, something like this is going to be a much bigger issue. The third one is, Ed is recovering cost of adjudicating claims under BDTR. And then when they add those in to recompute your composite score, you go below a 1.0. Now, in this case, you don't have to be below a 1.5. They would do this for any school. Obviously, not being an attorney, I know BDTR has got an injunction out there. It's on hold. I don't see, obviously, the adjudicated claims that can't be recouping at this point in time, obviously, from my understanding. So again, I think this one could have more light as BDTR moves forward. Maybe it goes away. It's just something we'll have to monitor and provide updates on. And the last one is if you have a change in ownership, CIO's change of ownership, that has a monetary judgment, again, award settlement under any of the three above at the end point, at any point, sorry, this should be not end point, this should be any point through the end of the second full fiscal year after the change of ownership. So if an issue comes up after you buy a school, for 2 full fiscal years, department can go back and recompute the composite score to see if the prior year was below a 1. I think they're looking for, obviously issues that maybe should have been accrued, maybe should have been identified. So if you're doing a stock sale and you're obviously assuming all the liabilities of the buyer, not just a Title IV, this becomes a much bigger issue. And so, it may point schools more to want to do asset purchases where you're assuming Title IV liabilities, but other legal liabilities of the institution are not flowing through to the buyer. So again, there's a lot in legal. Again, this is not Tom and I aren't experts in the legal from a high level. We have identified, seen these things, but anything you think fits these buckets, contact your regulatory attorney because they usually want to get them up to speed to help evaluate it. Equity tests. So this is something a little more in our bailiwick. If they're worried about withdrawal of owner's equity, and ED has been pushing for certainly wants more permanent equity in companies, right? Because that's what they want. They're more financially stable. So if you have a composite score that's less than 1.5 through the end of a first full fiscal year after a change of ownership, and there's withdrawal of equity by any means, including dividends, department wants to know that, and they're going to recompute your composite score to see if it goes below a 1. So part of it is, on deals that are using preferred equity instead of debt, and now you're taking dividends out, that has to be reported. And so this could really affect, entities as private equity investment getting returns out of it, could affect, what they feel they can draw out during the first full year and how those deals are structured and the equity in them. So that's certainly something, that would impact, audits and clients I've seen. And so have to, keep that in mind. The second one is a big one. If the institution's financial statements reflect a contribution in the fourth quarter of your fiscal year, and you take that money out in the first 2 quarters of the next fiscal year, you have to report that to ED. And remember, these triggers are self-reporting. You're on the obligation to tell them that, and not your auditor. And that distribution then, if department recompute your composite score, taking that equity out, and you're below a 1, you now fail the composite score. I've had some owner-manned schools start talking about, do I put in some investments, some marketable securities, which maybe don't have a large risk of market fluctuation. And instead of holding them personally, just put them in the company and leave it there. That gives you some more equity. Becomes a little trickier if you're a sub S, because there are tax rules around, distributions having to be pro rata if money's ever taken out. So, but I think it's still doable under a sub S as well. I've had someone ask me, well, what if I put the money in right at the end of the third quarter and then take it out in the first 2 quarters after the end of the fiscal year? I would tell you to be cautious. Department's intent is they don't want manipulation of the composite score, and they want more permanent equity in a company. And so I would be very careful of things like that. I mean, I think they're trying to find ways that equity is in the company, it's in there, This is what they've published, but I'd be careful just trying to skirt their rules on the technicality, because that is where I think you could get yourself into trouble. Tom, anything to add on the equity test, on the composite scoring?
I just wanted to clarify between this and the last slide. The first item on this slide and the first item on the other slide were the only ones that were the triggers that were if you already were below a 1.5.
Yes,
Everything
good
else
point.
is just in general, like regardless of what your composite score is, in general, all the other ones apply.
The next bucket is what I'm calling the threshold test, and just kind of what they are. And I think the next few items get easier. I think the hardest bucket is the legal and administrative. At least for me, the equity is pretty clear, and these threshold tests are things that are very straightforward. I'd call it black and white calculations. Gainful employment. If at least 50% of your title for aid in most recently completed fiscal years from GE programs that are failing. So obviously GE reporting's been delayed to October 1st. Department's still saying fiscal year 25 it's coming out. So we'll see. We'll see when they get those out. But obviously they feel if over 50% of your programs are at risk of failing, they're going to come back and ask for financial protection. Failure of 90-10 is obviously going to cause a financial protection, post letter of credit, escrow, whatever. And then cohort default rates. If your two most recent years are greater than 30%, unless you've challenged and filed an appeal, and that appeal would result in reducing one or both years to less than 30%. Obviously, most cohort default rates we've seen for the last year is 0 because of COVID. So I don't think this is on anyone's radar as a failing. And I'd say I haven't seen, even pre-COVID, a cohort default rate close to 30% for the better part of 15 years now. I just, even when I went to 3-year rates, I just haven't seen anything that high. So I don't think this is one that is as risk as much. So on this slide, GE is a little bit of an unknown of when it's going to come out. The 90-10 is hugely critical for a subset of schools and probably less critical for everyone else because you're far enough away. And the default rate is probably off most people's radar. What is going to be interesting as we start getting out of the COVID years and all this talk on loan forgiveness and to see what students are actually paying, to see what those default rates do. I am concerned there could be a spike as people just aren't paying back any loans, whether it's institutional loans, federal loans. It's yet to be seen, but it is a concern I have. The last bucket of mandatory triggers is what I've labeled as third-party events, because a lot of these have to do with third parties. So the first one is you have an institutional teach-out plan or agreement with the institutions required to submit one by a regulatory agency. I think obviously they're concerned about closure. Could be obviously issues about financial responsibility, profitability. So department's going to come back and ask for financial protection if a regulatory agency asks for a teach-out plan. I'm assuming this is a non-voluntary item and not just a teach-out of a program, because that's covered in discretionary. I don't know what happens if you decide to voluntarily teach. Like if you decide I'm going to close my school and you have a plan, you're going to teach out, you've got the financial capability to wind that down. If the department's going to require a letter of credit, because I do think in those situations, school teaching out may have got the resources and made strategic cuts and planning to be able to teach out. But if the department then requires a letter of credit, that could be financial capital they don't have. So it could almost be detrimental. I'm hoping that's where Department of Ed will maybe work with institutions to understand that, yes, we're on pace. We've got all the finances, we've made changes, and that they don't burden with a letter of credit, which could then hamper an orderly wind down. There's one here, a creditor event. If an ED action causes an institution to be subject to a default or adverse action under a credit agreement and other security agreements, which we've defined as finance and arrangements. I've not seen this specific, but what I'm getting at is there might have been debt agreements out there that prohibited a lender from enforcing action enforcing adverse actions because of an ED action. So it says, well, if ED does this to us, you can't then say I'm in default. So I've not seen that wording, or maybe I've just not picked up on it, but I'm guessing this was written from specifically ED has seen. And basically they're saying, listen, if we do something and your creditor's hands are tied, we don't want that to be an out then for not to have a financial responsibility issue. The last few I think are pretty clear. If you're declaring financial exigency or receivership, I mean, obviously you're in dire financial straits, and so department is going to, come back and ask for a letter of credit. And then there's, if you're publicly listed any, there is in the reg some various SEC actions, exchange actions, or reporting, which I did not list out. I think those entities, they're usually on top of these things. They know what those items are. They're out there to go read, but just to put it on your radar if you do fall under that. And I just listed these Roman numerals are unused. So we didn't, so just if you go through them, it adds up to all of them. It lists all the ones that are there, and that's just how you account for all of them. So I'm going to pause this and see if there's any questions on the mandatory triggers. I do see one that says the injunction on BDTR is on the recent Biden administration rule. However, claims are still processing under their old rules. Yes, which I understand that. What I don't know about the trigger, and I have a comment in here, I've not gone through a lot of these in real detail with some of the regulatory counsel, which I'm hoping to do as our summer conference season kicks off. But just say on the back on the slide for the legal and administrative, sorry, I went too far. Number C is if my understanding is that it has to be for claims that they've adjudicated and they're going to make the schools recover, but maybe not. I think it's something we can get some clarity on going forward. Okay. Oh, sorry, one, two, go back. All right, so discretionary triggers. So discretionary triggers, as we said, they're at department's discretion, right? And I've bucketed them similarly to the mandatory, slightly different, but a lot of the concepts. Actually, so someone just sent a question. Let me check this one. Would a breach of a covenant in a mortgage constitute a trigger? I'd say, yeah, a mortgage. Let me go back to that slide. A mortgage would, in the discretionary triggers, we're going to cover that because a mortgage would be a financial arrangement. So I don't think it would be the mandatory one that we went through, but we'll cover that in discretionary triggers, which I think that would possibly be an issue. So on the discretionary triggers, if you look at legal and creditor is my first bucket. So, and again, this goes into the question on the mortgage. So institutions subject to a default or adverse condition under a financing arrangement, except under C211, and that's referring to the mandatory trigger that we just talked about it. If you have a financing arrangement and you have a monetary or non-monetary default that allows a creditor to require increase in collateral, change in obligation, increase in interest rate, and the key word in there that says is allows. So even if the creditor doesn't, but that allows them to, I think that's some of the technicality, as these issues come up, you want to talk to your regulatory counsel, because the me allows doesn't say they have to, but if you've triggered it and the creditor said, yeah, I can do that, you have now tripped the requirement to report to ED. Even and the ramifications we'll talk may not be that bad if the creditor doesn't do anything, but you're still under an obligation. If the creditor takes action to terminate, withdraw, limit, suspend a financing arrangement, or calls a balance due, certainly if they're going to call your loan, that has got to be reportable. And then institution enters into a financing arrangement where the institution may be subject to a default or other adverse action as a result of ED's actions. I found that one a little confusing. It's similar to the mandatory trigger. It almost just seemed to me to be a catch-all on it. So I don't have a great example for that one. So I think the key thing is on any of your financing arrangements and credit arrangements, if you feel you've triggered a default or adverse action for the lender, going through, talking to your CPAs, talking to your regulatory counsel, saying, do you have to report anything? I have seen schools at times be proactive, realizing they may trigger something and restructure the credit agreement before the trigger is tripped. That could prevent having to report. I think that's when you want to get your regulatory counsel in early on and to look at the rules and to go through that, say, listen, if we are proactive and we change this financial covenant and then we don't trip it, then it seems like nothing would be reported. But I think that takes a strategic planning and looking out more than a month and a quarter, saying, where are we trending? Is there anything coming down the road that could be an issue? Because lenders don't move that fast. And if they've got to go back through their credit committees, you just can't expect them to revise documents in a short time frame. So other legal and creditors, institutions subject to a judgment awarding monetary relief entered against it that's subject to appeal or under appeal. I think the key word is subject to appeal or under appeal, which means this isn't final. But if you've got relief pending out there, again, this is another one, call your attorney, Tom, right? Again, this gets in a little bit of legal and how that fits, but you could have lost a settlement, you've now appealed it, and obviously I think you'd have to report it even though you haven't paid anything, because the department's now saying, well, this is a liability potentially, and we're going to recompute that composite score even though you haven't paid it. And then bar defense claims, pending claims under that citation, and ED has formed a group process to consider, and if approved, could be subject to recoupment. Again, I think this is falling under the new rule because it's talking about recoupment, which is only under the rules which are now currently in injunction. But again, so we just got to keep monitoring what happens with the BDTR claims and the impact on these triggers. Third-party bucket, again, similar to the mandatory. Accrediting agency and government agency actions, any action which show cause, probation, or comparable that risks your accreditation, authorization, or eligibility. The key word is that risks. I don't know how ED defined that risk. What about financial reporting? We've had institutions on that. Clearly, eventually financial reporting could risk accreditation being rebuked. I don't know how far they're gonna look down the line in ED's. How much latitude are they going to see, depending on what actions an accreditor may want from a school. State actions and citations, same thing, state licensing or authorization, include notice that your licensure or authorization will be terminated if compliance isn't reestablished. Again, that's all the regulation has. It doesn't, so the severity of what you get could be open to interpretation, and what you need to report and what you don't need to report, depending on what those letters say from these agencies. Loss of institutional or program eligibility to participate in another federal assistance program. I think this is clearly VA, where VA has told schools, have been very, some public cases out there where they're saying you can't participate in VA. So department wants to know, because they can now use that as a trigger possibly against the school for Title IV aid, requiring letter of credit, because they're saying, well, VA has problems, we want to get protection. Not sure that's fair. I think some of those cases where VA was lost by institutions have eventually gotten reinstated with, basically admitting of no fault. So it could be one of those things that could be unfair depending on how ED applies it. Again, and if you voluntarily withdraw from a program, another federal program, that seems to be different than losing eligibility. And actions by another federal agency. If you're cited and faces loss of education assistance from another federal agency, the department can come back and ask for a letter of credit. Again, it says faces loss, not lost it. So again, if there's just pending items, you've got another government agency that's pending taking away some programmatic aid, the department can proactively then, you have to report it, and the department can proactively then ask for a letter of credit. Couple things here. I'm thinking like the FTC. Like, I don't know how the Federal Trade Commission falls under there. We know the actions they've put out and have put schools on watch lists. That seems to be, that's another government agency that falls under the first bullet point. I don't know how, I'm not sure it risks accreditation or eligibility, but it is another government agency. I don't know about state AGs, right? If a state AG comes after you for an action, will that fit any of these? I think those are all questions as things come up at your institutions, you've got to look at closely to say, does this meet any of the triggers? If it doesn't, here's the documentation why we're going to keep on hand. We don't, but it's things you just need to have on your radar. The threshold bucket, similar. These are pretty easy ones, they're straight calculations, except for some of these, the data is unknown. Fluctuations in Title IV volume, there is no threshold. So I don't know if that's 5%, 10%, but if you're a growing school or shrinking rapidly, be aware that department could certainly be looking at the Title IV volume through G5 and say, we think you're growing too fast or shrinking too fast. We're going to ask for a letter of credit. High annual dropout rates, which is one that's always been in the regulation, and I think maybe even the statute, that's going to be computed by ED. And if I understand correctly, I think some of the gainful employment data that's going to get submitted is how Department of Ed is going to compute that, which is why they want information on not just your graduates for debt to earnings ratios, but they want stuff on withdrawal information and their start date, drop dates, because I think that's what ED is going to do, is they're supposedly going to compute a dropout rate, and then they would determine then if there's a discretionary trigger. I don't believe that rate has been established though, so there's just a lot of uncertainty, but this one certainly can't, I think nothing's going to happen on it immediately. Discontinuation of programs. If you discontinue academic programs that enroll more than 25% of your students who receive Title IV aid, department could say, we want a letter of credit. Or similar to the closure of locations, these are tied together. You close locations that enroll more than 25% of your students who receive Title IV aid. Department could say, this is a lot of students or are being impacted by location or program closures. We want financial protection. This is an area I think obviously that a school maybe can take a stance, maybe there's a financial impact. Maybe they are larger programs or larger locations, but the demographics have changed. The market conditions have changed in those areas. Maybe there's 90-10 issues and you've decided as an institution that we're going to retrench, but we're going to be a stronger financial institution, more secure by making this change. That is, you report it to ED, there could be data you provide to them that could alleviate their concern that, hey, we've been losing money here. So watch a big location. It's a big program that's the market's change is not providing value. So we will be better. Sometimes you have to shrink to grow. So since these are discretionary, we can provide the ED all your facts and circumstances for making these changes and alleviate concerns that they may have. So I think part of it is also thinking through, we've had institutions close locations periodically over the years, and the one that is specifically is used, they want to protect their balance sheet. They want to keep their composite score strong. So they looked a number of years down the road and had locations that were breaking even or just losing money. And so before they drained too much of the broader institution, they proactively closed them, and they closed institutions over a period of years. So you didn't have massive closures in 1 year that impacted 25% of your students, but they closed out OPIDs or additional locations and said, while we're smaller and we're half the size that we were, we're a much stronger institution. So having a strategic plan as well, and being proactive, looking down the road, can help you manage too many closures at one time, which I think just gives the department or any regulatory body panic when they see massive structural changes. And then the last slide on discretionary triggers, I could not come up with a better name for other. There was kind of stuff all over the board. So one's interim reporting. So if you're in interim reporting and your results are significantly different from what your projections were, department could come back to you and use that as a discretionary trigger. They say significantly lower. What's significant? Again, I think that's more than 1%. Does that have to be more than 10%? I think it's probably in that 5 to 10% range is where I'd start looking. But be aware that if you're providing information to department for interim reporting, and your actual results are a lot different, that could be a way for departments to come back to you. And in that case, you're already reporting them on interim reporting. I think they would have the information on that. Exchange disclosures, if there's stuff going on in public filing that's under investigation for possible violations of state, federal, foreign law, if they let Department of Ed know that, again, may ask for letter of credit, may not. Other teach-out plans, required to submit a teach-out plan or agreement, including programmatic teach-outs from regulatory agency. This could be, well, you're doing a programmatic teach-out, how big is the program, how many students, what's the impact to it? These would be teach-outs not included in the mandatory trigger. And then the last one is other events or conditions. It is just exactly that. Anything else Department of Ed wants to do, anything else they want to call it, Any other event they see, it could be, from an AG review, it could be from the FTC, it could be from another federal agency, it could be a public filing, anything they see that gives them concern, they've got the discretion to come back and certainly ask you for additional information if they think it's likely to have a significant adverse effect. And this is where it's hard. I get department saying we need to protect the taxpayer, but also it creates massive uncertainty for schools who don't have any idea of how strong department will be and if what they're asking is going to be fair to them or not. So I think we're just going to have to kind of wait and see as to what ED's request could be in this area. Tom, any comments you've got some?
No, I think there were a couple questions that came through.
The other one is, can you go back to the GE trigger and explain the consequences again? So if this would not occur until the GE rates are out, but if more than, I think it was 50%, if 50% of your Title IV aid is in programs that are failing GE programs, they're going to ask for a letter of credit. So again, until GE rates are published, it's not going to matter. But at that point in time, they're saying, if 50% of your aid, total for aid, is at risk of going away in a year, they're going to want a letter of credit for it. So, and there's one about legal proceedings. An employee lawsuit is completed before July 1st. Would it need to be recorded? That's a good question. I don't remember what the triggers are right now. I'd have to go back and look at the legal triggers. So there are triggers in place. They got revised in 2019 as part of the bar defense to repayment. I just don't remember exactly what those levels are looking. So I'd say go back and look at the current regs to see if you'd have to report it. They're certainly not as expansive as these regs that go in July 1st, 2024. All right, Tom. So I'm going to turn over to Tom to talk about how they're going to recompute the composite score and just a few things on alleviation then.
Thanks, Mike. So in relation to the financial triggers that Mike mentioned earlier, the department will recalculate, as you mentioned, the composite score. And so the question is, what happens when the composite score must be recalculated? Well, the department came out with specific guidance and the methodology for recalculating composite score. And Mike briefly mentioned earlier that they will start with the last year submitted audited financial statements, and they won't take any other current year data into consideration other than the specific event that was the triggering event. And again, it's a high level based on the numerator and denominator of the various components of the composite score. So when you have to recompute the composite score ratio related to the debt and the liabilities and losses, the primary reserve ratio, the increase in expense will occur, and then the corresponding decrease in adjusted equity would occur as a result of that additional expense flowing through the net income. And then for the equity ratio, there's the decrease in the modified equity, but there's been no change in the modified assets because typically in those situations, total assets will not be impacted. And then the net income ratio is the decrease in net income before taxes. And I would say no changes in the revenue because any of that kind of stuff is going to be related to expenses and not the revenue side of the net income for the net income ratio. And again, just a high level calculation. Nothing else is being factored in. Similarly, with the withdrawal of the equity, the primary reserve ratio, you'll just have a decrease in the adjusted equity with the pulling out of whatever equity was taken out. And same thing with the equity ratio, it will decrease the modified equity, but it will also decrease the modified total assets as the cash is coming out from total assets. In the net income ratio, there will be no change because the distribution of the equity won't have any impact on the net income or revenue. The item with the contributions before year end and then the distributions taken after year end. So this is when the situation you put money in the last quarter of the year and take it out within the next 6 months of the year. It's exactly the same as the withdrawal of equity, except they don't adjust the modified total assets is not lowered for the cash coming out. I think that's a little strange in that they're not decreasing total assets since the cash has to come out and it was there as of year end, but that's how they have it in the guidance to recalculate the composite score in that triggering event situation. And
I'd say that hurts you because your modified total assets are your denominator, so you're not getting the benefit there. So.
So there are various alleviate the triggers. And again, I think this is solely focused around like the fact that these triggers won't have a significant adverse financial impact on the company. So in related to the creditor, the documentation of violation was waived, or the conditions imposed will not significantly affect the institution's financial obligations, will will alleviate that trigger. And legal, I think this is more geared towards if there's insurance to cover the losses associated with the legal event that occurred. I don't think this won't apply to the borrower defense to repayment claims, because typically I don't think there's insurance right now to cover those types of claims. And then just other facts to explain the information about the conditions or circumstances for which the discretionary trigger event that demonstrate that specific trigger did not or won't have a significant adverse impact on the financial viability of the institution.
Yeah, I'd say we've seen creditors. We've had people fail covenants in a credit agreement, get a waiver, report that to ED with no department's basically said thanks, right, or never hear back. So I think I'm hoping that will continue. And then the last one is kind of that catch-all. If you talk about closing programs and locations, there could be very good reasons that make you a stronger institution. I think providing that to ED is, and I can't remember if you provide it when you report it or if the ED comes back. But again, as you got to report the triggers, those facts can just be looked at that time.
And I think going back to the creditor one, it's different than what Mike mentioned earlier about if you foresee a violation of a debt agreement and so you want to amend the credit agreement. Yep. That's outside of this. This is if that trigger did occur. We have seen situations where a school will go and modify a debt agreement or something like that because they are expecting to fail a specific covenant to adjust a covenant in order to account something for that they're specifically doing. So some of the questions for how prepared is your institution to take on these triggerings? Do you have a listing of which is disseminated to various employees and who needs to be trained on these new triggers? As Mike alluded to, it would be prudent to put them in various buckets to monitor. The same person might not be responsible for identifying the various triggers because they cover various aspects. So if you have a legal team internally or someone that's more in charge of that, obviously that person is going to be handling the legal stuff, but they may not necessarily be involved with the like debt violations or something like that, who, whether the CFO or someone on the accounting side might be better appropriate for that. But how do you assign and break up the responsibilities of the various triggering items with your employees? Who needs to be notified when the potential event is identified? When do you need to get regulatory counsel involved, or when do you need to get your CPA or auditor involved? Who's making the ultimate decision to determine on the triggering event? So what's the protocol for someone identified it? Now, where up the ladder does it go to determine whether or not this is something that truly believes needs to be reported to the department? And then who will report it if necessary? Along with all this stuff to alleviate everything, you want to have a process to obtain documents. And I would say if you identified a triggering event, it would be prudent to start obtaining the documents. If you think you're going to alleviate that with other stuff, I would probably do that all at the same time, so you don't send it to the department and then have to scramble later to gather that information. And then who is recomputing the composite score before the information is provided to Ed, so you're aware of what the impact of that trigger event is going to be. And availability to post financial protection. Do you have a process in place that if you're pretty certain this is going to cause some type of letter of credit, have that process ready and ready to go, just so once the department sends you the notification, it won't take long to finish that process.
Yeah, and just to say, actually, some of these stuff, as we prepared for this presentation, I can't say I really thought that deeply on those internal processes before. And I know something this year, as we're wrapping up audit calls and doing some on-site client meetings this year, we're going to sit down and go through. It's kind of like, wow, this is something we could help clients do, right? And think through this, just because it's, as was mentioned earlier, there's so much else on your radar. This is something that maybe just didn't get enough attention at some institutions, because we have found some settlements and, under the old rules back to 16, where someone had a $5,000 slip and fall, and it's like, yeah, you're supposed to report that, and they're like, well, we didn't know. And so they did after the fact, and department was was fine because there was just very minimal impact to the institution, obviously. But being proactive is certainly better.
And also from like our standpoint, auditing, like asking the question, were there any triggering events? You ask one person, and if they're not knowledgeable of the triggering events that need to be reported, I think the immediate knee-jerk reaction is going to say no, because it sounds negative. And obviously these things are negative things in the eyes of departments. So who are the right person to ask when your auditor does ask if there are any triggering events, and how you go through that process of communicating the information to your auditors. So next, we're going to talk about the general standard of financial responsibility. In other words, the composite score, which is something I think is fun. I don't know if others necessarily agree, but I do enjoy working on composite score projects. So obviously the current regulations of the composite score is going to be a 1.5 or greater. There are other standards that are sufficient, that have sufficient cash reserves to make the Title IV refunds. Whether you fail to make the refunds, fail to make payments to Ed for the debt or liability, and whether they're subject to a trigger event. The additional regulations effective July 1st or like the late payment of credit balances, undisputed financial obligations greater than 90 days, unauthorized use of retirement or restricted funds, and unpaid payroll obligations, and expanded triggering events, which obviously Mike reviewed the triggering events. But those other items, yeah, if you're using the retirement funds or other restricted funds for that are unauthorized of use, is also stuff that will have the impact on the financial responsibility of the institution.
Yeah, and we don't think they're looking at one-off late payment of credit balances or one-off bills that get paid in 90 days. They're looking for systemic issues where people are not making refunds, credit balances, paying invoices because of financial struggle. I mean, that's certainly what our take on it. And I'd say unpaid payroll obligations. Yeah, frankly, I think IRS, by the time ED gets there, I think IRS would be standing at the door saying, "What took you so long?" The IRS moves fast when they find unpaid payroll obligations haven't occurred. So my guess, they'll already be. The school could be, potentially in trouble with the IRS before ED even it would respond.
So some of the other general standards is the audit opinions and disclosures, and it includes the adverse, qualified, or modified opinion or disclaimer of opinion. Disclosures include a note about the diminished liquidity, ability to continue as a going concern, or ability to continue operations unless Ed determines it's alleviated. And the late filing of the audits is not a prudent step. Like, so if you submit your audit after, like that's referring to the late submission of the audit, right?
Correct.
Yeah, so you submit the audit after June 30th for December 31 year end. You're just determined not financially responsible, regardless of what the composite score or anything else. So obviously, no one would want to submit late, and we would recommend trying to submit earlier, just in case they reject it, and things need to be updated. That there's no question as to whether the resubmission was performed timely or not.
Yeah, the going concern, the department does is they can make a different decision than what's in the audit report. So if it's a going concern and the audit says it's alleviated, the department can say, we disagree, right? So there's always that risk. I had 2 calls, no one we're doing audits on, about filing audits late. They both came in February, which I had not had that call for a while. I think that's a bad step. My analogy, I told him I was watching Raiders of the Lost Ark with my wife and my young son, and those of you who've seen it, they pull back the top of the tomb and there's all the snakes, and the fellow says, ask, very dangerous. That to me is filing a late audit. That is a very dangerous thing to do, because you could letters of credit, provisional PPAs, administrative capability. I just don't think you want to file audits late. So keep that in mind.
And then we also have just a couple composite score reminders related to the financial responsibility. There is no change in the composite score formula. I'll say the underlying formula of everything, but the way you arrive at the adjusted equity and modified assets and the various components of it obviously did change. Some of them specifically related to property, plant, and equipment, and the debt with the pre and post implementation. So with the pre-implementation, PP&E and debt can't increase. So it was established. You can't increase the pre-implementation because it was assets or debt that was acquired prior to that pre-implementation date. Eventually, all that pre-implementation PP&E and debt, PP&E will be fully depreciated, and all the pre-implementation debt will be paid off at some point and go to zero. So at some point, that pre-implementation of the property, equipment, and debt will totally go away, depending upon how long that stuff's depreciating and the payment terms of the debt. Leases, a change of control or change of ownership of a school, it converts all leases to post-implementation. So that's just a reminder in any kind of acquisition that's planned. If they have leases that were pre-implementation leases, the business decision of acquiring that school is used to, I'll say, modify or amend the agreement that the date of the transaction becomes the most recent date of that lease agreement. And then modification of leases after 12/15/2018 makes a lease the post-implementation lease. So if you had a lease that existed prior to that date, but then you modify it, amend it, extend it, and even takes into consideration if it had a 5-year renewal option built into it, but you did not include that 5-year renewal option in your original lease right to use asset and lease liability determination, adding that 5-year option now taints that lease and it will make it pre or post implementation as opposed to being pre-implementation, because similar to the property and equipment and debt, that it's the value that was set on those pre-implementation lease without it increasing after that date. Intangible assets related, other obvious ones like goodwill and accreditation and that kind of stuff that acquires in it is part of an acquisition's, I think, usually self-explanatory, but it will also include internally developed software, curriculum development costs, and more recently with Ed's position on deferred tax assets, that they've been considering that an intangible asset as well. And other comprehensive income and losses, related to interest rate swaps, foreign currency translations, it might be other comprehensive income or loss, but those type of items that how they impact the composite score. So the income can be used to increase revenues, and then losses are like you have to report the losses, but then they're excluded from total expenses when calculating the composite score, using the total expenses. And Ed, in April 2022, Ed did issue a Q&A.
That was 2020, not 22, 2020.
2020,
Yep.
that addresses a lot of these issues that were related to the changes in the composite score with the pre and post implementation stuff.
So there's a couple of questions. One is an annual market adjustment in rent considered the modification of the lease. So that's no, because when that lease was put on your books, it was put on the books with that annual market kind of adjustment considered. So that would not trigger it. Now, if you went back to the landlord and took on more space, took on less space, renegotiated the lease, that would then be a change in the lease that would possibly taint it. And there's a question, having to respond to an incomplete letter after the filing deadline considered a late filing. So this is where you send it in June 15th, you hear back July 2nd, department said there's something incomplete and you got to resubmit it. We have not seen those type of issues be considered late filing. I think if they're severe, they could be. Like if for some reason department keeps rejecting your submission, then I think you want to be careful. We've not seen some like a one-off typo or a department's asked a question, and sometimes departments rejected them and department's been wrong, and we've had to resubmit then and say no, it was right, and department has acquiesced and said yeah, it was a bad question, or they've rejected it for minor items that are just kind of silly, and then you make a little change and they accept it. So historically, that has not been considered a late filing. But if you've got significant issues and they reject it, I think you want to be careful. So I know we're coming up on 3 o'clock, sorry, Eastern time. Certainly, if there's other questions, Tom and I can entertain them. There's definitely a lot in here, which is obviously, I think, these types of things, you're not going to get all this in one shot. So can continue to look at the regulations, to talk to your counsel, to figure out how you're going to educate people in your organization as well. But we'll stop for a second to see if there are questions.
Yeah, it doesn't look like there's any additional ones at this time.
So either we've explained it really well or we've just really confused them. And so no one even knows what to ask.
Option A, Mike.
Great. Is that pretty much it for us today, Mike and Tom? Just want to check and see if you have any final thoughts or comments for the group.
No, I think we're good. Just try to stay on top of it, as I said, and along with all the other things you're trying to manage, and reach out with questions. I think it's the best thing to do.
Perfect. Thank you both. As a reminder to all of our CQ member attendees, today's webinar will be posted on the CQ website under the events tab, along with all of our past webinars. Again, if you need help finding that or logging in, please let me know. Before we wrap up, I just want to provide a couple quick reminders about some upcoming events. The next in-person event is the Career Education Convention in Indianapolis, June 11th through 13th. Registration is open for that. If you have any questions about the event, please let me know. In July, we'll host our annual Leadership Institute, which is a leadership development workshop that takes attendees through different campus operations to help advance their career. That event will be held July 8th through 12th in Chicago at Aviation Institute of Maintenance. In addition to our webinars, we encourage you to check out the Career Education Report podcast, which is hosted twice monthly by our president and CEO, Dr. Jason Altmeyer. All of that information and registration links can be found on our website, career.org. And thank you again to Mike and Tom for today's presentation, and we hope you all have a great rest of your day.
Thanks for having us.
Thank you.